Dear students, welcome to Dr. B.R. Ambedkar Open University. Today we are going to discuss an important topic on financial management and introduction. Before knowing about what is financial management, we all do understand that every businesses require funds. So funds are required and finance is the lifeblood of any type of business. Basically, funds are required for two types of activities. To run the business, we require funds, and funds are required for the fixed assets as well as for working capital purposes. So, the funds which are required to run a business, if that is applied to business, we call it as business finance. So, first we try to understand what is the meaning of business finance. Business finance is basically an activity, a function which is concerned with the acquisition and conservation of the capital or the resources to meet the financial requirements and also to attain the overall objectives of the business enterprise with which it has been set up or with which it has been incorporated. So, business requires funds, and if it is applied to businesses, it is called as business finance, and it is applied because most of the businesses are corporate, so it is also called as corporate finance also. If it is applied to agriculture, we call it as agricultural finance, and if it is applied to healthcare, then we call it as healthcare finance. So, like that, it is depending on what is your type of business organization, accordingly the finances are required. So, in this context, we have to understand what is this financial management then. So, financial management is that specialized function of the general management which is related to the procurement of the finance and its effective utilization for the attainment of the goals. That is basically that general management function, wherein we also have a specialized function, that is finance function, where the basic objective is to raise the funds, to utilize the funds, and also administration of the funds. So, we can understand the financial management broadly in the following manner by answering the following answers, giving the answers to the following questions. The financial management is broadly concerned with the acquisition, raising and usage of the funds by a business firm. So, what is the scope of this financial management, which can be well understood in terms of the following questions? So, if the firm is able to answer these questions, then we can understand what is the meaning of financial management. Basically, how large should the firm be and how fast should it grow? So, this question will tell you how much amount of funds you require. If the firm want to expand the business and it want to grow and it want to increase its sales turnover, then they require funds, they require finances. What should be the composition of the firm's assets? So, as I told you earlier, funds are required basically for fixed asset purposes as well as even for working capital purposes. So, what must be the composition? That means how much amount we have to invest in terms of fixed assets and how much amount in terms of working capital, that is in terms of current assets. So, what must be the composition? So, depending on the composition of the firm's asset, also the funds have to be raised. Then what must be the mix of the firm's financing? Now, there are different sources of raising the funds. Among those different sources, we have the equity financing, we have the debt financing, loan financing. So, basically, we have to know what is going to be the debt equity mix. So, what is the financing options available to the firm and how much they want to raise in terms of debt and equity. So, they have to understand this in order to understand the financial management. Apart from that, the firm should analyze, plan and also control its financial affairs. So, basically financial management deals with not only raising of the funds, utilization of the funds, analyzing the funds, planning the funds and controlling the financial affairs of the business. So, all these questions give the answers and it will relate to how financial management is related to the business. So, financial management basically is also a part of general management function. Now, we will try to understand what is the meaning and definition of financial management. Finance function, it is agreed that finance function is the most important of all the business functions. So apart from planning, controlling, coordination, budgeting, reporting, all the other functions, even finance function is also very, very important and very crucial for the business. So financial management refers to that part of the management activity. So it is also a part of the management activity which is concerned with the planning and controlling of the firm's financial resources. So there are a number of definitions which give you what is the meaning, what is the scope, what is the nature of financial management. Among those various important definitions, the two important definitions which are given by J.L. Massey and Weston and Brigham, these two definitions throw light on what is the nature of financial management. They also tell us what is the scope and what are the functions of financial management. So financial management basically is an area, it's a subject of financial decision making, harmonizing the individual objectives or individual goals and enterprise goals. So we have to harmonize, we have to synchronize the individual goals with that of the enterprise goals. According to Massey, financial management is that operational activity of a business enterprise that is responsible. So they have to carry out this function for obtaining effectively utilizing the funds which are necessary for efficient operations. So to carry on the operations efficiently in any business organization, we require funds, we require finances. So focusing on that particular activity, so that activity is carried on by specialized or professional people, and that is called as financial management. So financial management is a very, very important function, and it is a very, very important professional function which has to be carried out by professional people who have a knowledge about how to carry on this function very effectively and utilizing the funds in an efficient manner. Now, after understanding what is the meaning and the definition of financial management, now we have to understand what is the scope, what are the functions, what is the scope of the financial management, what are the functions which the financial management carries on. So the approach to the scope and functions of financial management is broadly categorized into two categories. So in order to have a better understanding, so the scope of financial management is broadly categorized into two categories. So first one, we call it as traditional approach, the very old approach. And now on the requirements of business organizations, now we also have a modern approach. So between traditional approach and modern approach, we have a transitional approach. So basically there are two approaches to understand the scope of financial management. So one is the traditional approach, the second one is the modern approach. So now we will try to understand what does the traditional approach say about the financial management. According to the traditional approach, which is very popular in the early stage, where the role of the financial management was very, very limited, was limited only to the extent of only raising and only administration of the funds needed, which are needed by the corporate enterprises to meet their financial needs. In traditional approach, the focus was only on raising of the funds and only administration of the funds. It did not give any attention on the utilization, on the management, on the controlling of the funds. So the traditional approach did not serve the purpose of the utilization of the funds, that is the financial management could not perform the all types of functions which are required according to the new approach. So in the traditional approach, the funds which have to be raised by the organization, they are being raised and they are being only administered by the financial manager. So the scope of financial management under traditional approach is very, very narrow. It deals only with the following aspects like arrangement of funds from financial institutions. So the role of financial management according to traditional approach was confined only to the extent of only arranging for the funds from the banks, from various financial institutions, and also arrangement of funds through various other financial instruments like shares, debentures, bank loans. and also looking after the legal and accounting relationship between an corporation and its sources of funds, maintaining the records, administration of the books, administration of the administrative function of finance. So they only used to take care of only the legal aspects and only the accounting relationship between the organization and that of its sources of funds. So the traditional approach suffers from the following limitations. So the main limitations of the traditional approach are, it is basically external in nature. The approach is basically external approach. It doesn't focus on internal aspects. It only focuses only on the external aspects. So it is basically has an external approach, and it also ignored the routine problems like whatever the funds which are required for meeting your day-to-day requirements, for meeting your day-to-day resources, or for meeting your day-to-day expenses. So the traditional approach majorly focused only on raising of the funds which are required only for meeting your long-term requirements. It ignored routine and the operating problems. And it also ignored non-corporate enterprises like service organizations and other organizations which are of corporate in nature, non-corporate in nature. And it also ignored working capital financing. Working capital financing is required to meet your day-to-day requirements like payment of salaries, meeting operating expenses. So this approach never focused on working capital financing, and there is no emphasis on allocation of funds. So traditional approach basically only aim at only raising of the funds and only administration of the funds. They never focused on allocation of the funds, distribution of the funds, and at the same time the time value of money is also not considered in this particular approach, because time value, that is, we are raising the funds to meet all your long term requirements, but the time value of money is not considered under this particular approach. So in order to overcome the traditional approach, now there is a modern approach. So the modern approach to meet the corporate needs or the needs of the current organizations, the organizations in this competitive environment have to focus more on other functions of financial management, which is met by this modern approach. According to this modern approach, the term financial management provides more conceptual and analytical framework for different types of financial decisions. So that means the finance function according to this modern approach covers both acquisition of funds as well as their allocation, their utilization, and also increasing the profitability, making investment in those type of projects where it will maximize the firm's value. Now this new approach views the term financial management in a broader sense, in a very broader sense, where it is viewed as an integral part of overall management, which is not found in case of traditional approach. Traditional approach is narrow in nature, where it viewed financial management as a very limited function. According to modern approach, where it is treated as an integral part of overall management, the function, it considers financial management into four categories. Financial management according to modern approach is divided into four decisions. So the whole crux of financial management is based on these four pillars. So the whole financial management could be understood based on these four major decisions. The first one is investment decision, which is also called as a capital budgeting decisions, where the firm have to take decisions on investment on fixed assets, capital expenditure decisions. The second one is the financing decision, where how to raise the funds, what are the sources of funds, what is the optimal capital mix. So how we are going to raise the funds by using debt or equity. So what are your debt equity options available? So how to maximize the EPS by raising the funds. The third one is the dividend policy decision, where we are going to focus on whether dividend decisions are relevant or irrelevant. So whether funds are required so for meeting the requirements, or whether whatever the surplus profits which are available, should we declare a dividend out of it, or whether we should retain them for the expansion of your business. And the fourth one is the working capital management decision, where the decisions pertaining to investment in current assets like cash, receivables and inventory. So basically working capital management deals with the management of the investment in current assets. So according to the modern approach, financial management is very broader, and it can be viewed in terms of the following four major decisions, that is investment decision, financing decision, dividend policy decisions and working capital management decision. After understanding the scope and what is the nature of financial management, now coming to what are the objectives of financial management. So the objective of financial management can be broadly classified into two categories. So we have to, in order to understand the financial management in a very clear manner, we have to understand what are the objectives. So what are the objectives of financial management? So the objectives can be classified as basic objectives and other objectives. So the basic objectives are, that is basically for the survival of any organization. So the organization should earn profits. So accordingly, the basic objective of any type of business organization is profit maximization. So one of the basic objective of the organizations is maximization of profit. So what is this maximization of profit? So profit maximization is a term which denotes how much maximum profit the firm can be earned in a given period of time. So the profit maximization goal implies that all the decisions, that is the investment decision, financing decision, dividend decision and working capital management decision of the organization should be oriented towards the attainment of maximum profits. So whatever the decisions which are taken, whether it is an investment decision or a financing decision or a working capital management decision, the focus should be on maximizing the profits. So all the decisions should be rooted towards only the attainment of maximum profits. All the decisions should be oriented only for the profit maximization. So this is the basic objective of any type of organization, and this is also one of the important objective of the financial management, that is maximization of profit, or it can also be called as profit maximization. What are the advantages of this profit maximization objective? In case if the firm is going to have as this objective, if they are going to have profit maximization as their objective, then what are the merits of this function or of this objective? So the advantages of profit maximization objective are, the first one is basically profit maximization objective is a best criterion for decision making. So whatever it can be taken as the measure for evaluating the performance of the business or the firm, it can also be treated as a yardstick to judge the economic performance of the enterprise. So profit maximization objective can be regarded as the best criterion for decision making because it provides a measurement, it provides an assessment to judge the economic performance of the enterprise. Then apart from the best criterion, the profit maximization objective also offers efficient utilization of resources. So it leads to efficient allocation of the scarce resources which they tend to be diverted to other uses in case if profitability is not there, and if you don't invest in profitable projects or in profitable investment options. We have to make an efficient utilization of resources, and these resources should be invested only in those projects or only in those type of investment alternatives where it is profitable, and profitability is the most desirable criterion. Apart from that, there is an optimum utilization of available resources is also possible because the investment is done only in those profitable projects, because the objective of the firm is to maximize the profits. At the same time, the maximization of the social welfare, the society also can be benefited by making use of this profit maximization objective. So it will maximize the overall benefit to the society in terms of availability of the service services, availability of the goods at the cheaper prices, at the quality products at cheaper prices. So that also can be attained by using this objective, that is profit maximization, as the objective of one of the basic objective of the financial management. So every term has an merit, at the same time it also suffers from a few drawbacks. So what are the drawbacks of this profit maximization objective? The major drawbacks of profit maximization objective is, some people argue that the profit maximization objective does not consider time factor, that is, it does not consider time value of money. That do we mean that we are going to have if we are going to have profit maximization as the objective, that means we are aiming at the profits which we are going to earn in the next 10 years or in next 5 years. By that time the value of the money must have been declined. So time factor is ignored, and the term profit maximization is also very vague, because we does not mention what type of profit we are asking, where we are discussing whether it is a net profit or net profit before tax or after tax. The term maximum is also ambiguous, because there is no upper limit or a ceiling for maximum. It also ignores the risk factor, because as the time prolongs, there is again an risk element which is present in the projects. And in the new business environment, or in this complex environment, maximization of the profit cannot be considered, because it is unrealistic, it is difficult to define, and it is inappropriate, and it is also immoral. So these are all the various drawbacks of profit maximization. So when we are not considering profit maximization as the basic objective, then we have to look upon what must be the other objective where the organizations can have as their objective. So accordingly, the other objective of the financial management is wealth maximization. So wealth maximization is nothing but maximizing the wealth of the shareholders. So maximizes the net present value of a course of action to the shareholders. That is how we are able to give a maximum wealth to our shareholders in terms of increased market share, increased market price. So accordingly, according to this particular objective, wealth maximization objective, the shareholders' current wealth can be maximized by increasing the current stock price per share, by increasing the market price per share. This objective is going to account for the timing. It considers time value of money. The risk is also taken into consideration, and it also the benefits, whatever the benefits we are going to earn during the period of that project, we can measure them in terms of cash flows. So accordingly, the basic fundamental objective of wealth maximization is nothing but how we are able to maximize the market value of the shares, that is the shareholders' shares, by increasing the market value with whatever the courses of action or whatever the operations we carry out in the process of carrying on the business. So the wealth has to be maximized, and that can be attained only by increasing the market price of the shares. So this objective of wealth maximization has a lot of significance, because most of the people agree to that profit maximization has very limited role to play, and it can never be considered, it cannot be considered as an objective in today's era. So now it has to be considered as some other objective has to be considered, and that some other objective is wealth maximization. So this wealth maximization objective takes care of all the stakeholders. So it takes care of, now in case of traditional, that is under the profit maximization objective, the stakeholders were only the internal management, whereas in case of wealth maximization objective, it takes care of lenders, the creditors, workers, internal management, employees. It also ensures a fair return to the shareholders, and also at the same time it focuses on how to build the reserves for the expansion of the business in terms of retained earnings, and it will also ensure financial discipline in the management by following this objective, that is ensuring financial discipline also can be attained with the help of this wealth maximization objective. Now, financial management is very, very important because it is a focal point for all types of your decisions, and it is also one of the very important instrument or measure for measuring the performance. And for running the smooth running of your business, we require financial management, and the success of the business also depends on how we are able to manage, carry out this function of finance function effectively and efficiently. What is the relationship between the financial management and with that other areas of management? As we understood from the previous slides that how important financial management is in the organization. So without finance function, we cannot carry on any other function. So financial management is very, very important, and it has to be integrated and it has to be coordinated with other functions. And the other areas of management where it has a relationship is production department. For producing, for procuring the material for production, we require funds, we require finances. For materials department, the materials have to be purchased, it has to be procured. So materials department require funds. Personnel department, the HR, the human resources, for employment of the human resources, for investment on the human resources, for taking different types of decisions pertaining to the personnel department, selection, recruitment, all these functions we require funds, we require finances. At the same time, marketing department also require finances for the promotion of your product, for the selling of your product. Apart from that, even accounting department also has a relationship with that of the financial management. So in totality, we can say that in an organization there is not even any single department which is left over where you cannot function with the help of finance function. So finance function is very, very important, and to sum up, we can say that financial management is a very, very broader area where all the functions of management will fall in place, and without financial management the other departments cannot work and they cannot carry on their operations. And for the smooth functioning of the various activities to run the departments, to run the to carry on the various operations, to run the business, funds or finances are required, and accordingly financial management also is a very, very important function which we cannot ignore and we cannot give least importance to that. And accordingly financial management is very, very important to any type of an organization, irrespective whether they are trading organizations, service organizations, or they are into non-corporate organizations. Every department requires funds. So in an organization there are so many departments which require funds and finances, like sales, production, material, personnel department, marketing, accounting. Then even in case of, if it is an non-corporate organization, or even in case of service organizations, or even in NGOs, or even in case of service organizations also where they don't do any type of production, but also they require funds. For an example, even a school or even a college or an hospital, they also require finances, they also require funds to run their business, to run their operations, to run their activities. So every organization require funds and finances. So the financial management is required in any type of organization, and to carry on this function of financial management, a professional people are required to run the business. So accordingly financial management has gained importance in the recent past, and accordingly in this competitive environment, so we require professional people to carry on this function, and accordingly most of the times financial management is a key function and it is a part of the top management function. Thank you.